Hey, welcome to What in the Real Estate with Amy Mullen Thornton from RE/MAX Professional Associates. And my special guest today is Rich Kruczynski from RSK JR CPA Inc. And he's going to be answering some of our most common tax questions that I get asked in real estate all the time. So, Rich, when we're talking about first-time homeowners, they always want to know what are the tax deductions that they can look forward to becoming a homeowner.
So today, the most common is the mortgage interest. Taxes as a whole, real estate taxes, auto excise taxes, income taxes are limited to $10,000 under the current tax laws. So real estate taxes certainly are one that are deductible and certainly help people, bring people to that $10,000. Also, if the taxpayer has private mortgage insurance, depending on their income threshold, they may be able to deduct. The most important thing to remember today is that because the standard deduction rates are so much higher, for a married couple, it's much harder to reach the threshold to itemize with the limit on the taxes of $10,000.
Interesting. So even though they bought a home, they still might not be itemizing because their standard deduction is still going to benefit them more.
Correct. I would say that when the laws changed for the 2018 tax returns, about 75% of my clients that used to itemize are now taking the standard deduction.
Excellent. And what that's for a single family home. What are some other or differences if it's a multifamily and say they're an owner occupant?
So if they're an owner occupant, their portion would follow the deduction rules: mortgage interest, real estate taxes, private mortgage insurance. However, the rental portion, you'd be able to deduct that portion of insurance. So if it's a 3-family, 2/3 would be deductible. If they pay any of the utilities, any of the repairs that are done within the units. So there's a lot more benefit to that portion. Also, you're able to depreciate that portion of the property over the course of 27.5 years for a residential rental.
Excellent. And that all comes back to if you're starting out by being an owner occupant, your first investment property, then obviously record keeping and good tax returns are essential.
Record keeping is always essential, even if it's single family home.
Yes. The second most common tax question I get from my clients is when they're doing a sale and a purchase. So they're already homeowners, they're selling their home, they're buying another home. And there's two typicals in this. And I say typicals, not everyone fits into the typical, but most common. One is people who are buying up. So they have their starter home and now they've saved some more money and are taking advantage of the great rates. So they're selling their starter home and buying a more expensive home. And then the alternative is they're downsizing. So they have a larger home and they want to go into a smaller one. So they're selling a more expensive home and buying a least expensive home. How is that handled on their taxes?
So the purchase doesn't matter. It's the sale of their primary residence where it factors in. Currently, for a single individual or married filing separate, there's a $250,000 gain exclusion. For married filing joint, it's a $500,000 gain exclusion. So people who may have bought their house 10, 15 years ago, especially a single individual, may be looking in today's market at having a possible taxable gain on the sale of their residence. What they purchase for the new house does not matter. Personal residence is not subject to like-kind exchanges where you would have that issue. It's the sale of the personal residence. That's the number that matters. Now, for taxpayers that may have bought years ago and have had a spouse pass away, it's important to try and get an appraisal as soon as that happens, because there's a step up in basis for that half of the house that the deceased spouse owned. That's a situation I've run into 3 times in the last week and a half.
Wow. And that's really good advice, because I bet you no one's thinking about that at that time.
And there are so many other things going through people's minds. It is not.
Wow, no, that's so what they buy does not matter, whether it's more expensive or less expensive.
Correct.
There's an exclusion, 250 for single, 500 for married filing joint.
On the house that they're selling,
On their house that they're
as
selling.
long as they've lived in it, owned and lived in it at least 2 years, 1 day of the last 5.
Okay, and then what happens if they go above those numbers? Is it capital gains tax?
It is capital gains tax. Massachusetts is currently 5%. Federal would depend upon your income level. It can be 0%. It can be up to 20%.
Wow, okay, so those are important factors to consider.
And the basis of the property isn't just what you purchased for. If you made any improvements, if you redid your kitchen, if you put on an addition, if you put on a roof, those increase your basis in the property and reduce your gain or potential gain. So record keeping is important.
I was just going to say record keeping, absolutely. And then our last question for today is, the pandemic pushed a lot of people into working from home offices and working from home, and some people are going to stay that way. So there's a big difference between working in a home office when you are employed by a company versus working in a home office because you're self-employed, correct?
Correct. So under current tax law, starting in 2018, business use of the home is no longer deductible for a W-2 employee. If I'm working for somebody else, I'm not able to deduct any of my expenses. If I'm self-employed, I can take the percentage of my business use, and it needs to be dedicated business space.
Okay.
So the percentage of that house, I can take the various expenses. I can take the utilities, the real estate taxes, the mortgage interest, the insurance, repairs, as part of a deduction on my Schedule C.
Okay. So that's important. So if you are working for a company and you do maintain a home office in your home, you're not looking at anything extra on your taxes as a deduction. But if you made improvements to that area of the home in order to work from home for your employer, that would be a step up in basis to the value of your home.
Correct.
And then,
but the tax rules are changing constantly, and by the end of this year, you may be able to take those deductions. It's a different Congress, it's a different party in Congress, different party in the White House than it was when these current laws were put into place. So it's always important to pay attention and have a tax professional that stays on top of these, because there are so many different changes.
Absolutely, and consult anytime you're making big changes, like looking at buying and selling a home or changing employers, and just having your taxes in order. You need to do that for any mortgage application anyways, whether you're refinancing, purchasing, or investing. So it's always good to have a good record keeping and a great tax professional.
Yes.
Awesome. Well, thank you so much, Rich, for all this information. His contact information is below. As a realtor, I highly recommend that you have all of this in order before you do any real estate transaction, because as you've just heard, there are tax effects that you're probably not even thinking of, because when you're buying and selling real estate, you're not thinking taxes. You're thinking space, you're thinking relocating, you're thinking right sizing. You're certainly not thinking what's going to happen on my 1040 next year. So if any more questions, contact Rich. And thank you for joining us for this episode of What in the Real Estate. And if you have any questions, feel free to type them in below and we'll get them answered. So have a great day, Rich, and thank you.
Thank you, Amy.